Hello, this is a tradesight educational video discussing the concept of quarterly futures contract roll and what it really means to the market, why it tends to lead to lower volume in the stock market and futures market for a couple of days. Quarterly roll occurs on the Thursday going into Friday before the expiration or triple expiration of futures, options, and commodities. So this will happen in the months of March, June, September, and December every year. It's 4 times a year only. And basically what happens is the big money shifts from trading the contracts that are about to expire into trading the next contract that's good for a new quarter. And they do this pretty much in unison on the Thursday, and that's today actually, June 13th, 2013. They start trading the September contract in this case, and the volume starts to come out of the June contract. Now, the reason that happens is because the money needs to get out of the contracts before it expires, and as it gets closer to expiration, there's other factors that go into that. So the big trading goes on in the contracts that are liquid and that don't have an expiration pending, and they all move together. So here is, for example, the 5-minute chart over 2 days. This is Wednesday over here and Thursday over here, June 12th and 13th. On the ES, the E-mini, S&P 500, this is the most commonly traded futures contract. And what you can see here, if I go right to the beginning of the day on Wednesday, you can see what the volume sort of looks like for the first hour or so, pretty good. And like any other day, it drifts off and gets a little light and then maybe comes back in the afternoon. If we take a look instead at the next day, which is Thursday, volume was a little lighter in the opening hour and drifted off a little bit more during the middle of the day, and then picked up a little bit in the afternoon. Now, let me show you the September contract instead at the same time, and what you're going to see is a very clear distinction here. Notice how on Wednesday there was really no volume in the contract at all. The price still moves the same and in sync with the June contract, but there's just no volume and activity there. And then all of a sudden on Thursday, boom, the volume starts to come in. By Friday, all of the volume will show up on this contract, and if I go back to the June, the M3 contract, it'll look like this Wednesday here. You won't see barely any volume at all. Now, there's an issue from a technical trading perspective when this occurs, and let me show you what I mean by that. Let's go back and let's look at the June contract, and what I'm going to do is I'm going to add our futures levels to the chart here, and basically these are levels that we use for a variety of ways to trade the market. The shaded area is a value area, for example. We've got the pivot series, is the pivot in the R1, the S1, R2's off the top of the screen. These extend out. If you shrink the chart, you can get levels going out even further. And these are, the red lines are the breaks, which are key GAN levels for us, or Murray math numbers. The green lines have their own meaning. The purple lines have their own meaning. Each of these is a valid technical calculation of the market, and what happens is we get these numbers and we apply them to our trading for the next trading day. So for example, what you're looking at right here, and it just got kind of wiped, there we go, what you're looking at right here is the levels for Thursday's trading, but we're now going to do the calculations tonight, and we'll have these new levels to work off of for Friday. And that's where the technicality of this futures contract roll really comes into play, because if you really think about it, if I go to the pricing here, here's the June contract closed here on Thursday at 1636.75. Now let's go ahead and look at that September contract, and it's 1630.75. So it's actually 6 points lower than the June contract, which is nearing expiration. They're not the same numbers, okay? And so what you'll find is that the levels, usually we've been using the June levels, the June data for creating these technical levels that we use the next session. And from a trading perspective, this is very important. A lot of the big money uses these types of calculations that we provide. And so for them to suddenly roll to the September contract, which is, as we can see here, about 6 points off of the June contract, but we have to go where the volume is. There's always going to be that one day where suddenly, and that's today, where suddenly we're going to have to start using the September data on the September contract to apply to the next day's futures calculations for a trading perspective, but there really isn't full volume yet in that contract. And so because of that, a lot of people will sort of sit out that day, a little less trading than normal, because they can't rely on the technicals of the market the way that they normally would. This has a much bigger role in the market activity than the average person, or really 99% of the public, understands. So this technical shift between contracts really creates a lull for a 2-day window in the market, and that's, again, the Thursday and the Friday, a full week before expiration. So here we are, we're sitting on June 13th and 14th is when this lull occurs in the trading volume, and then we jump to next week. The 21st will be triple expiration of options, futures, and commodities. Very important point. It happens, like I said, 4 times a year. And it's really important for understanding because the volume is so much lighter in the market, and we had really poor volume in the stock market this morning because of it. Trading is a lot less technical, and a lot of the rules we usually use on a day-to-day basis won't apply or work in our favor because the market just doesn't have it in it without all the volume. So it's really important to understand when this occurs, and that it isn't just, oh, one day we're trading the June contract, one day we're trading the September contract. That shift in where the volume lies plays havoc on the actual technicals that the big money relies on to trade that market. So there's a much bigger impact than just moving the volume from place to place.